All right, welcome to Retire Japan TV, where we talk about personal finance, investing, and life in Japan. I am so thrilled to have Dean Yoshimoto with us today. I first came across Dean on LinkedIn, where he's very active, he's very helpful, and I was really impressed with some of his answers. So I asked him to join us on the program, and he's here, and he's very kindly agreed to answer some of your questions as well. So. We'll be having a conversation, and then as we talk, I'll try and bring in some of the comments and questions from people watching live. Now, you might have noticed there's only two of us here today. So my co-pilot, my co-presenter Daniel can't make it today, so I'm a bit gutted about that, but still very excited about talking to Dean. So hi, Dean. Thanks for coming along tonight.
Hey, Ben, thanks so much for inviting me. This is actually the first time we're sort of talking face to face. I think it's just been chat messages on LinkedIn. Glad to be on board here. I haven't really been, so active. This is actually my first podcast, I would say. Yeah, so I haven't really been active on the internet and stuff. So please bear with me. I hope to give you guys some helpful information, some actionable items in a relatively short period of time. So
Awesome. Thanks for taking the time to talk to us today. And I think, the Retired Japan community is quite friendly and nice. So it should be a good start for you in social
okay,
media.
take it easy on me. I'm a little bit rusty.
Cool. So because Dean is a professional, he did ask me to do a quick disclaimer here. So I'll just read that out super quickly, just so we're all on the same page. So obviously, all views expressed in the podcast are for informational and possibly educational purposes, and should not be construed as legal advice. So the information is just for reference and is bound to change in case of any amendments or changes to applicable laws. We do not assume any responsibility or liability for any errors or omissions in the context of the podcast. And we don't make any warranties about the completeness, reliability, and accuracy of the information expressed in the podcast. So basically, we're just trying to provide you with information, and you should certainly consult with a professional or the legal authorities if you have any questions before you make any decisions. Having got that out of the way, Dean, could you tell us a little bit about yourself? So I understand you're a US CPA and a Japanese tax attorney?
No, I'm not qualified in Japan, just in the US. Yeah, I'm a US CPA. Just a little bit of background about our structure. My wife and I, we work as a team. She's actually the owner of a Zeirishi office. She has a Zeirishi license, which is a Japanese tax accountant license, and also a EA, which is an enrolled agent, basically specializing in US and Japan taxes. Myself, I'm a US CPA registered in the state of Arizona, and I'm also focused on taxes as well. So just a little going back in history, my wife's company started 2 generations before her, actually. So her grandfather started the business a little bit after the end of the war. And so they've been in business about 75 years now. And I kind of came into the picture when I decided to work with U.S. clients. And so we opened that part of the business in 2005. Initially, I was working from home. And I got a lot of referrals from like the U.S. Embassy and things like that. That was before I was a CPA. But once I had passed the tests and got all my certifications, we decided, why not work in the same office? So we kind of added that portion on. And so we're more or less like a international tax accounting office now. So
that's awesome. Yeah. So the wife came first and then the CPA qualification.
Yeah. Well, actually, we started when we were first married in Hawaii. I was, working, and she was, still studying, and then we decided to make the move to Japan, and then she was able to get her Zeirishi license after a few years, and so we kind of switched back and forth, and so she's sort of in charge of the company, and I'm sort of more of a helper to her, I guess I would say.
That sounds very much like my wife's company as well. Fantastic. So Um, what kind of work do you do day to day? What does your kind of normal day look like? Are you
Okay,
working for one
so yeah,
specific person or?
since we're a small office, there's all kinds of odds and ends. I also, in addition to taxes, I do the billings for the company. I'm sort of the in-house computer guy, although I'm not, a developer or anything. I kind of, from my previous corporate job, I was like sort of like the de facto system administrator. People just basically come to me and complain about why their printout is stuck and things like that. So I kind of carried over to the office, and I'm sound like the IT guy. But my main focus is working with U.S. clients with IRS taxes. But as you can imagine, people, typically they also are from a certain state, and depending on the state they're from, such as Hawaii, California, you also have state reporting requirements as well as federal IRS. Okay, folks from say like the state of Texas, where they don't have any state income tax, so they have no reporting requirements. So it really depends on where you're from, and also another key issue is many states consider you to be, even though you moved to Japan, they consider you to be have a temporary absence from Japan. I'm sorry, not from Japan, a temporary absence from their state. So, for example, if you're from Hawaii or California, unless you specifically state I'm permanently leaving California or Hawaii, they will assume that you're just temporarily gone. Okay, so what that means is you still, in their eyes, you're still a California, say, or Hawaii resident, and so you have to keep up with tax reporting requirements. Essentially, you have to still pay taxes until you formally declare. So that's kind of a big, in Japanese they say otoshiana, right? A trap where if you're not aware of that, you could say be all hunky dory here in Tokyo. Say, I just have to report to, the Zeimusho in Japan and to the IRS. But then, you might sooner or later you might get a letter from, say, like the state of Hawaii tax office saying, oh, our records show you haven't filed. Please file as soon as possible. And a lot of people at that point they panic and they just procrastinate. And then the second letter might be, we give you 90 days to file. And a lot of people still they sort of freeze up. They don't know what to do. And the next letter typically, well, according to our records, you owe us, $5,000 in taxes. You have 90 days to pay. So, that's their due process. Typically, they go through maybe 3 steps or so, but typically in the end, once you get to the point where they're billing you, you typically have to just pay or, hire attorney and then go through the formal court process. And so
that gets quite expensive quite quickly.
Yeah, that's something you have to sort of be wary of. It's fine if your state allows you to be a temporary resident and they only tax you on, say, California income. That's fine too. You still have to file, but in your filing it'll show that you don't have any Hawaii or California income. So you have to read the fine print and make sure you're clear. On the IRS side, there's kind of no gray area. You always have to file, and usually you don't. I think 60% of the residents outside of the U.S. they don't pay taxes. But if you're sort of a high earner, typically if you make about $120,000 U.S. or more, and if you're single, typically you would pay a little bit of taxes starting from there, and going up into 150, 200,000, you'll just keep on paying more and more taxes. Typically, you won't exceed probably $20,000 or $30,000 from our customer experience. So even if you're at a CFO or a high level executive here in Tokyo, even at that level, you probably wouldn't pay more than $30,000 US. And that's
Right.
thanks due to, and I'll get to this a little bit later in the presentation, and that's due to as you pay more salary in Japan, or as you earn more salary in Japan, you also pay more shotokuze, or income tax. And that income tax is eligible for foreign tax credits. So you can offset your U.S. income with the taxes you pay from Japan.
All right. So technically, you're not going to be double taxed.
Yeah, that's the intent. At least.
Theoretically.
Yeah. I'm sure you know Japan and the UK, they have a tax treaty. U.S. has tax treaties with 70 or so countries. Pretty much, any country that anybody would want to live in, and that's the basic premise: is avoidance and mitigation of double taxation. Some treaties are more generous than others. They allow you to resource your income. But in most cases, the taxation issue by informed tax credit. So in some cases, you might have enough credits to cover your income. In some cases, you won't have enough. And so you'll just pay the delta portion, the difference between, say, in our case, the difference between what you'd pay in Japan and, say, typically the higher rate in the US. You'll just pay the delta or the difference, if that makes sense. And so, if I give a kind of a simple example, if the tax rate in Japan is, say, 30%, and the equivalent for the equivalent salary, the tax rate in the US is 40%, then you would pay the 30% to Japan, and the excess between 30 and 40 is what you would pay to the US typically.
Because we have we have a specific question about what you were talking about before. So how would you go about telling California or Hawaii that you're not resident anymore?
Yeah, that's a good question. Most states have a online form, and if you go to typical in California, it's ftb.gov, I believe. In Hawaii, they have a website. And most states have a pretty modern website where you can accomplish things online, and you just fill out the form online. In the worst case, probably you'll need to print out, say, like a PDF form and fill out your new address, basically, and send the form in by snail mail. So I mean, all in all, it'll probably be a 10-15 minute process to get that out of the way. Okay. The other, while we're on that topic, Ben, I want to mention also is that your residence is not just determined by what you put on the form. You have to demonstrate also that you are a bona fide resident of Japan. For example, there's things that could disqualify you. And this is kind of scary is, for example, I'm more or less from Hawaii. So if I were to, say, register to vote in the state of Hawaii and say, like, hold an address in Hawaii, as well as, say, renew my driver's license in Hawaii, things like that, the state of Hawaii might view me as still a permanent resident of Hawaii, despite me filling out a form. So it's not just the form itself, but it's your actions as well as your intent. Okay, so even though you accidentally do those things, because the typical person wants to hang on to their driver's license for obvious reasons, you could still make the claim that, well, my intent was to still live in Japan as a permanent resident, but I just wanted to upkeep my license and vote in the U.S. But you may have some legal problems down the road, so you might want to make a clean cut sooner or later, and say not vote in the U.S. in any state, give up your driver's license. Most driver's licenses recently they require you to have a residence in that state as well. So you probably have to give it up anyway. So
a lot of people tend to give a relative's address as their own just to avoid paperwork.
That's a problem.
That could come back and bite them, I guess.
Yeah. So we have quite a few. I wouldn't say a lot, but we have quite a few cases where people use their old college buddy's address in the U.S. on their tax forms, and you have to realize is that when you file with the IRS, there's a sort of a central database, and the states have access to that information. So soon after they file, they say, "Oh, Dean, guess what? I got a letter from the state of California that says I need to file." It's like, how did they find out? It's like, well, when you file with the IRS, if you have a California address, guess what? They're going to zoom in on that, and they're going to, sort of take advantage of that information. So you have to be careful what kind of information you let out. Even agents are known to scour through the internet, right? So if you're posting things, say on LinkedIn or whatever, about how you earn tips at a restaurant tax-free, or you have this side business and things, and you're just sort of baiting them to look at your tax return. If you don't have a Schedule C or E supplemental or self-employment income schedule on your tax return, they're going to be able to call you on that. Well, on the online on the internet, on YouTube, you're bragging about all this fancy income, and so your self-employment business and this and that, and so how come you haven't filed, have you reported that income? So
the IRS is following you on
yeah.
Instagram, basically.
Yeah. I mean, it's you're easy bait, right? I mean, people, they're proud, and a lot of times you want to brag to your friends, but you just got to be careful of what you put out there.
Right. We do have another, hopefully quick question
Sure.
about taxes. So this is my first year working in Japan. Can you explain the process for getting a credit for Japanese taxes in the US? I'm from Texas, so no state taxes. Would this be the foreign earned income exclusion, I guess?
Yes. So if you have the slides, Ben, this might be a good time to start the slides, or because actually the first slide addresses that. But
okay. Did you send me the slides? I don't.
Yeah. Okay. No problem.
I don't think I got those. So.
Okay. So, but great question from Chris, former Texas resident. But so to qualify for the foreign, they have what's called the foreign income exclusion. So basically, your first $120,000 of income that you earn abroad is excluded from taxable income. Okay. So the way you qualify for this is usually two ways. Either you live in, say, Japan or any other overseas country for a full calendar year. Okay, so that would be, say, like if you just came in June, you would have to, for your qualifying, you'd have to go through June of 2024, but also to the end of 2024, because you need a full calendar year. Okay, that's one way to qualify. Or you can pass the time test, which would be 12 consecutive months. And within those 12, so basically from June 2023 to 2024, within those 12 consecutive months, you would have to have at least 330 days within Japan. So basically, you can't go on a vacation for more than, say, 30 days in that 12-month period. Okay, those are the main two ways you'd qualify. And then if you're under 120 grand, basically you would exclude that income on your tax return using various forms, and you would be able to be, have no taxable income, be tax-free for U.S. However,
okay, Dean, I'm very sorry. I did find the slides. That was entirely my fault.
Okay.
Here we go.
So, yeah, as you can see on here, you have, the requirements, of course, it says on the top left, start here, do you have foreign income? Yes. Is your tax home in a foreign country? That's another requirement. So you have to be obliged to pay taxes in Japan. So, for example, if you're in the U.S. military or certain, say, embassy officials and ambassadors and things, typically they're under the so-called SOFA agreement. So they're technically, although they're in Japan, technically it's still like they're on U.S. soil as far as taxes. So they're not subject to taxes in Japan. So therefore they can't qualify for the foreign income exclusion. Okay, so you have to be sort of a normal expat. You just came here, non-military. You work for a typical company in Japan, and you have to pay, shotoku-zei, jumin-zei, various other taxes, and those taxes would qualify. And you also, if you look at the chart, if you scroll over to the right, you also have to be either a U.S. citizen or a resident alien. Okay, And resident alien, that's kind of confusing. What's that? Basically, it's just a way of saying green card. If you are either a U.S. citizen or if you have a U.S. green card, you're sort of treated the same as far as U.S. taxes go. Okay, and you can see below that there's sort of a maze of complications on how you qualify and this and that. I won't get into all the details of that, but basically most U.S. citizens and most green card holders would qualify for the exclusion. Okay, and that's a big deal because I think, as I stated earlier, probably 60% or more of expats abroad qualify for this, and they pay no U.S. taxes. And it also simplifies the process because it's just an additional form, and it's more or less a 1-year qualifying period. So it's pretty straightforward. Yeah, straightforward.
That's quite nice. If you're going to be taxed abroad, then I guess this helps.
Yeah, and I would think most people, in this situation, would be able to, say use TurboTax or even just go to the IRS website, download the PDFs and file themselves. Because basically you just need an additional form for the foreign income exclusion. Okay, you probably are able to do it yourself, I would say.
Okay.
So a lot of people.
I have a quick question about this, actually.
Sure.
Which is, if you do not claim the foreign earned income exclusion and end up paying American taxes, would that make your future Social Security higher? And would it reduce your Japanese taxes?
Okay, that's an excellent question. Okay, Social Security tax is kind of its own animal. Okay, in the sense that in the U.S., okay, I know if you've ever looked at your pay stub, if you work in the U.S., it's very confusing, right? You have U.S. income tax, state income tax, and then you have things that relate to Social Security, and it's usually marked as Social Security taxes. There's Medicare, things like that. But because those are in their own category, by not paying federal tax, it doesn't affect your Social Security. Okay, what you're putting into Social Security. Okay, so I know that's a bit confusing, but basically, I guess to put it simply, once you leave the U.S., unless you are specifically paying Social Security taxes, your Social Security benefits will not grow past that point. Okay, so that's what you need to be careful of, right? Because if, say, you plan to work for 30 years and the first 10 were in the U.S. and the remaining 20 are in Japan. That's kind of like my situation, by the way. I worked the first 10 years in the U.S., so I do have 10 years of Social Security. It's not much, but once I came to Japan, for the remaining of my work years, say 20 years, I can pay into the Japanese Nenkin system. Okay. Now, there is a way to pay into your U.S. Social Security as an option. Okay, and the way that's done, but it's only open to self-employed people. Okay. So if you're, say, in Japan, and I think, Ben, you're more or less self-employed, right?
Pretty much, yeah.
Yeah, okay. So if you're like Ben and you run this self-employment type of business, you would file the self-employment form, which is Schedule C, I believe, on your IRS tax return, and you would report, both your revenue and below that your expenses, subtract expenses for revenue for net income. And then that income that you make from your self-employment, you could apply the foreign income exclusion to that, but you still are technically required to pay U.S. Social Security taxes on that. Okay, so you could continue to pay Social Security and Medicare. That's the requirement. You need to continue to pay Social Security and Medicare, and I think the total is about 14% taxes for the two. So that would allow you to continue to accrue Social Security benefits. Okay. If you're already paying Nenkin in Japan, which Nenkin is a statutory requirement, right? So basically, you have to pay Nenkin, or technically you might not get your visa renewed, right? Technically, you might have to even leave Japan because they won't renew your visa after 5 or 7 years or whatever your visa length is. Okay, so but you could if you don't want to pay in both countries, which is sort of how you can't really afford to pay pensions in both Japan and the U.S. So they have it's called a totalization agreement. Okay, the Social Security totalization agreement between the U.S. and Japan allows you to pay in one country. Say you continue to pay in Japan, and you don't pay in the U.S. And there's a procedure for doing that. But you're able to apply the total credits to either country, okay, or both. So it gets kind of confusing. There are a lot of rules, okay. So you could say, in my case, in 30 years, I would have 20 years accrued from living the last 20, living and paying in the Japan system, 20 years, and my first 10 years in the U.S. So total, I have 30 years. So I could say, run some scenarios on the spreadsheet. Also, the SS.gov site in the U.S. has some, scenario analysis type, calculation worksheets that you could fill in and figure out what's the best situation for you. You might get more Social Security if you get paid in the U.S., or you might get more if you get Nenkin from Japan. In some cases, you could maybe say split it up, conceptually half and half, Japan and the U.S. So you'd have to kind of run through those scenarios and see which is best for you based on your tax situation. So it gets very complicated. But of course, we can help you with those types of analysis. And we have done a few of those.
What's the normal result? What's the typical result in terms of optimal strategy?
Yeah, I think typically most people, they neglect the U.S. Social Security side, and most people they're not self-employed. So typically, it's better for them to keep paying into Nenkin on the Japan side.
Okay, we have another question about basically, I think, non-filing, basically.
Oh, okay, yeah.
I guess question. This person lived in Japan, didn't bother filing their tax returns in the US, and what's the consequence going to be?
So I think this is, I wouldn't say a frequent problem, but I think it's sort of half. There's sort of half and half compliance. I would say half the people I meet have not filed at all, and half have been diligently keeping up with the system. Okay, so. I think the thing you have to be most worried about is, if you look at this exclusion at the top of it, it says, can I claim either exclusion or reduction? Okay, so the key word is claim. It must be claimed, or else basically you don't have it. Okay, so it's not a given right. It's something you have to consciously go out and claim. Okay, and the way you claim it, of course, obviously, is by filing a tax return. Okay, so as long as the IRS doesn't come to your friend and say, sooner or later they might pick up on your friend not paying taxes and send out letters and so forth, and perhaps in the last resort they might send a nasty letter that says, you have to file, but even if you do file, you are not able to claim the foreign income exclusion. Okay, and that would be really devastating. They have the right to do that. It's not a right. It's a privilege, and it's a privilege you have to claim foreign income exclusion. So, I guess what I'm saying is, yes, it is a huge danger in that sense. Okay, so can you imagine
ignoring it is not going to make it go away? Right?
It's just gonna snowball. Okay, right. So let's say if he's typically if the typical American, I think in the 30s or 40s, by that age you're typically making 100 grand, 150 grand, something like that, and typically you might tip over above the exclusion threshold, and also you might have a family and kids, and basically you just have a lot at stake, right? I mean, you're not just typically people come here to Japan as a single and they do the JIT program and they don't really think about the future, so they're not so diligent about uh, filing U.S. taxes, but it compounds. There is a statute of limitations, and a lot of people may mention, well, they can only come after me for 3 years or whatever statute of limitations, and they try to play lawyer and hope that they're protected by the statute. But it's very clear that in many cases there is no statute of limitations. For example, in cases of crime, or if there's substantial what they call tax evasion, substantial amounts of tax evasion, right? So they could perhaps extend the limitation period indefinitely. It could be, so you would basically have no limitations, no right. And and I guess in the end, it would be very hard for you to move back, because once you have an address in the U.S., instantly they would bill you for it, right? And they would come after your assets, your bank accounts, your house, things like that. So it's very, very dangerous. So
don't ignore the IRS then.
Yeah. So please take care of that right away. You might even, if they're a high earner and the period is over 10 years, it might even be wise to hire an attorney in that case, because probably if you're not filing U.S. taxes, you're not complying with FATCA regulations. So FATCA is the Foreign Account Reporting Act. And so there's layers of reporting you need to do for your bank accounts, for your assets, if it exceeds certain thresholds. And those penalties are typically $10,000 a pop per offense. Okay, so if they send you a warning and you don't reply, it's 10,000. If they tell you to file a FBAR and you don't file, then that's another 10,000 they might add on top of that. If you have additional counts that they find, it'll probably be another 10,000. So it could easily be $30,000 or more of fines, right? So basically, for most people, that could be, half or more of their life savings, right? It could change your life drastically. So, but I'm kind of doing the scare talk, but on the bright side, there's ways to come clean, okay? And typically, what we recommend for people is to file a certain amount of years. I can't say whether it's 3 or 5, but typically it's less than 10. But we would have to take a look at how much money you made and so forth. We'd have to do more or less a risk assessment to see what your risk is. Where you're, also what it makes a difference. Do you have a house in the U.S.? Do you have bank accounts that they could garnish? That would increase your risk profile, of course. But if all your assets are now in Japan and you really don't have any assets in the U.S., then it's also a different scenario. So
right, they might be more amenable to negotiate at that point.
Yeah. It's really case by case. So,
okay, we have another tax filing question, which might be good here. So this person's been filing, Lawrence has been filing using the foreign tax credit method, which allows him to claim child tax credit. Would it be better to use the foreign earned income exclusion method, or in what cases would that be better?
Okay, Ben, I have to commend you. You have a really, really intelligent audience members here, and they're all asking great questions. And so Lawrence, this is the point I wanted to get to, is because a lot of people assume that you can either take the exclusion or the foreign tax credit. Because if you read the instructions, that the instructions in the IRS instructions kind of alludes to either one or the other. But the truth is you can take both. Okay. Ooh. So the way that works is that, say, for example, I think the example is the easiest way to visualize it. Say you make 200,000 US, okay? And as I mentioned, the foreign income exclusion excludes the first 100,000 or so, right? Mm-hmm. Okay, so that leaves you with 100,000 taxable income, okay? But on that remaining income, what you can do is you can apply the foreign tax credit to that remaining income, okay? So, however, your foreign tax credit will be limited to a percentage of taxes you pay. Okay, so how do you calculate that percentage? It would be this is sort of just, it's more complicated than this, but typically because you excluded half of your income was 200,000, and you excluded 100,000, that would be half or 50%. Therefore, you would only be able to use the remaining 50% of foreign tax credits. Okay, so I know that might be kind of confusing, but basically you can use both, but you would have to reduce your foreign tax credit based on that percentage that I just mentioned. Okay.
Right. What if your income's under the foreign earned income limit? Can you
Yeah.
choose to use some of that allowance, or do you have to use the whole 120,000?
Yeah. Okay. The thing about the income exclusion is once you use it, the IRS wants you to continue to use it every year. Okay. So they have a rule is that if you don't use it in a subsequent year, say like it was more beneficial, or you had some sort of reason that you wanted to use, it was more beneficial to use foreign tax credits, say the following year, you can, but the penalty is that you won't be able to go back to the old system, the foreign income exclusion for 5 years. Okay, and after that 5 years is done, you have to ask the IRS for permission. You have to essentially go through a letter ruling process. Okay, and that typically costs maybe $1,000 just to go through that process. Okay, so you're going to have to pay money. I mean, in the end, it might be worthwhile. Okay, because in the end, you may have run the numbers and it saves more taxes for you to go back and forth between both systems. But you don't have you don't have carte blanche. You don't have the freedom to go back and forth as you wish. You have to go through these procedures. You have to ask the IRS for permission and pay those fees. And in the end, they could reject you, right? They could say, no, I'm sorry. You have to stick to the foreign tax credit system. Okay, in that case, it could be detrimental, depending on your situation, right? Whether you're making a salary, or if you change from salary or self-employed, it might be beneficial to switch and things like that. But if you can't go back to the system that's preferential, then you'll just lose out. So just make your decisions wisely when you make the decision to change from one to the other. You can always use both. Okay, I guess the key point, to sum it up, once you use the foreign income exclusion, you need to keep using it pretty much.
Okay, so you want to really think ahead before making any decisions.
Yeah. So I think the weakness that I see most Americans, not just Americans, I mean anybody, right? Myself included. You have to look past what you're present. You have to forecast what am I going to be doing 5 years from now? Am I going to retire in 15 years? Am I going to, a lot of people typically they'll work a salary job for the first 10 years. And of course, if they're ambitious, they want to quit their job and start their own business. And then their tax situation changes at that point. And then, so on and so forth. And also, as you get older, you accumulate investments. And so you need, if you buy a house, I know, Ben, you're doing a lot of podcasts and posts about owning a house and things like that. And so the interest earned deduction or the interest paid deduction, all those things just add up. And as you get older, your taxes get more complicated. So I have some clients, they file 100 pages of tax returns. It's just incredible, right? I mean,
Wow.
it's like it's almost like a phone book. You could use it as a weapon almost. I mean, yeah. So as you get older and wiser, typically you might start your own Japanese KK, or you might partner up with a friend, go 50-50 on a KK, things like that. And as long as you're a U.S. citizen, there's tons of reporting you have to do still. The what so-called informational returns. So as an American, pretty much anything you do is reportable. If you have income from a trust or a foreign estate, if you are involved in a foreign company. Also, I think, Ben, you alluded to in some of your NISA and your other podcasts, Americans have it typically hard because of the PFIC rules, right?
I was about to
So
ask about that.
yeah, so
So,
maybe this is a good segue to go into that. So, say for example, um, once you live in Japan, typically, I mean, all your income is typically yen, right? Unless you have a rental in the U.S. So you're gonna be putting your yen savings away in a savings account and earning nothing basically. So now they have NISA and all these other investments. Is it worthwhile for you to get those? And you have to, I think, view it with caution. Okay, and the biggest caution is, I would say, or the biggest problem is that the U.S. has very complicated rules for owning shares in a foreign company. Okay, they have so-called PFIC rules. Okay, and P stands for passive. Okay, so if you invest in the typical mutual fund, that's a passive foreign company. Okay, if they earn either 75% of their income from passive investments or have 50% or more of passive income assets. Okay, and your typical mutual fund meets those thresholds. Okay, so you fall under PFIC reporting requirements. Okay, so your typical this is true, especially I've done some research on this, by the way, and with Japanese J REITs, for example, real estate investment trusts in Japan typically have a corporate structure, so they definitely would fall under PFIC rules. Okay, and
okay, so something like Toyota would be okay because it's
yeah,
a
Toyota
company.
a typical company like Toyota is not, it's not obviously they have employees, they sell cars, they have product development, so they're a normal company, they're not passive. But a mutual fund is basically pooled money, and they're just throwing it into the stock market or bonds or whatever, and so there's a big difference between passive income and active income. So Toyota would be, I would say, active income for the most part, right? They're selling cars. They have offices globally, so you can invest in Toyota and it wouldn't be a problem. Okay, but if you invest in a certain kind of a fund that includes Toyota, then you might have a problem because that fund might be classified as a passive foreign corporation. Okay, so
Okay,
that's what you
so
have.
what's the problem with PFICs then?
Okay, so yeah, so getting to that, um, it's very complicated, and the taxation on that, I guess to put it in one, it's punitive taxation, and under this taxation, you might have to pay as much as say a 50% rate or more on your say like dividends. Can you imagine? Okay, can you imagine? Right, you're typically paying,
Wow.
yeah, you're paying, say you're in the 20% tax bracket, 25%. So typically you pay the same amount on dividends earned, 25% on dividends as well as your wages, right? But say, oh, you bought this J REIT, which is a PFIC, and because of the punitive tax scheme, you're paying 50%, say, on just for those dividends, right? So you might as well not buy it. I mean,
Yeah.
if you're paying that much tax, I mean, what the hell, right? You might as well put the money under your mattress, right? I mean, so, and not only do you pay, but I think some of the forms, if you look at the IRS instructions, the the uh, the typical time to complete the form is 24 hours or something, right? So can you imagine a typical accountant would probably charge you $50 to $100 an hour, right? So can you
Okay.
imagine paying $2,000 or more for just the PFIC reporting form? I mean, it's
And
just
that's for
ridiculous.
each one, right?
You probably, yeah, probably for each. Yeah, can you imagine? So if you own a J REIT for Tokyo, or for Mitsui Fudosan or whatever, you own two J REITs, that's probably, $4,000 just for the forms, right?
Which
And
allow
on
you
top
to
of
pay a
that, yeah,
50%
and
tax on
on
the
the top of
dividend.
that, I mean, you're gonna make maybe, I don't know, 3% in dividends or whatever, and you know after taxes, you're gonna make less than 1% or less net after. Now, is 1% worth it, right? I mean, you might as well leave it in the bank. So be careful. Uh, some companies will you have to sort of scrounge around for this. This information is not easy to find. I think certain countries like Canada have done a great job with their, if you look up Canadian funds, because they also have this PFIC problem. But if you look up a typical Canadian mutual fund, they have PFIC information right on the website. This fund has 50% of PFIC, blah blah blah, right? But in Japan, there's not enough interest or investments for them to put it on their site. So you're sort of on. It's the Wild West. You're sort of on your own. You have to research. I've done a little bit of research, but most of the research I see, it was done in the 80s or 90s. There's nothing really current about what kinds of funds are PFICs.
And some companies might be too, right? Some of these holding companies that
yeah, definitely, right. So
their own investments.
You mentioned Toyota. So there's Toyota Motor, but typically there's like a Toyota holding company that might be, say, holding all sorts of foreign exchange or things, because they do a lot of business abroad. So naturally, they're going to have foreign exchange reserves, which they're going to put into investments as well, earn interest and dividends on until they decided to use it for operations, of course. And you could be, unknowingly investing in those companies as well, right? So probably at the least, that could be a few percentage of the stock you own. And you might not even know it, right? I mean, I think even the company executives don't even know, right? Because
why would they, right? If they're listed in Japan, it's a US tax rule.
So I think what's happening is that Americans are being sort of, I wouldn't say discriminated against, but they're sort of being discouraged from investing abroad, right? Because as you know, it's really difficult for Americans to say, like, cash a check or to open savings accounts and things like that, because many banks will just, once you say you're an American citizen, they'll just say turn you away, or you have tons of extra forms you have to fill out, and they don't know themselves how to fill them out, right? Because they're so little, they're so new, and the laws are changing all the time. And so best to avoid any complicated investments as much as possible.
So I think the basic advice is for Americans to just invest in America using US brokers and US ETFs and so on.
Yeah, definitely. So I think in the past there was, the typical, my typical customer would invest in, say, E-Trade, Schwab, Merrill Lynch, TD Ameritrade, and slowly but surely those options have just disappeared. I get calls every so often saying, what they said, because I'm American, I have to close my account. What should I do? And so I think we're down to maybe one or two brokerage companies that do take Americans living abroad. Okay. The other thing you can do is you might be able to use a relative's address, and so. But then
that gets you into the tax residency, doesn't it?
You might want to check into that, because there could be legal ramifications for that as well. But typically, the people who still have the accounts are more or less using their old address from when they used to live in the U.S. They opened an account then, and they moved to Japan, but they just kept the account open. And some companies, I know, they grandfather you in if you're in that case, but they're just not opening any new accounts because there's many more laws now.
Yeah, there is one option in Japan, which is the Interactive Brokers company, which recently switched to Japan. So Interactive Brokers Japan is now taking new clients. So if you're a US citizen, that might be a good option for you if you haven't got accounts already.
Okay, that's news to me. The only other one I've heard was, I think, either was TD Ameritrade or E-Trade. I think were the other ones I heard of. But I know Merrill Lynch pretty much kicked everybody out.
Yeah. So we've talked about filing IRS taxes, and we've talked about PFICs. Are there any other kind of things that people don't tend to know about that they should?
Oh, okay. So going back to the slideshow, I think the last two slides talk about, it would be, I think, then pages 8 and 9, talk about tax treaty. Yeah, okay, there's one. This one's kind of sideways. I don't know if you can turn it over.
Yeah, I don't think I can do that at the moment.
Oh, okay. Maybe if you
everyone just turn your heads.
Yeah, maybe if you go to the next slide, then page 9. Okay, so this basically tax treaties are very complicated. So I think if you just look at this table, it's kind of self-explanatory. You see, I've circled Japan, and if you look under, there's columns at the top: interest, dividends, pensions, and annuities. So you can see the numbers there in those columns: 15, 12 and a half, 10. Those are percentages. Okay, so if you're this doesn't apply typically to Americans, but this applies more to non-Americans or Japanese. I would say Japanese citizens who invest in the U.S. And receive dividends would be limited. So if you look like in the dividends column, it says column 6 paid by U.S. There's a 15 in that column. If you go down to Japan, or rather a 10. So the maximum rate that you would pay on dividends you earn from the U.S. as Japanese citizens, if you claim and apply the tax treaty, would be 10%, which is very favorable, right? Typically, you would pay 20% or more as a Japanese citizen.
I think it's 30 if you don't. You don't have this kind of thing. The default.
I think that
gives you 10.
The typical withholding is 30%. But if you fill out the certain forms, you can claim exemptions from withholding. So they won't withhold anything if you fill out the forms properly. I think you have to have either a social security number or ITIN number to claim those tax treaty benefits. And but you still need to say file a non-resident tax return, such as the 1040 NR. And pay those taxes typically. Okay, so but to sort of address tax treaty issues in general, the tax treaty is pretty much the document that makes the foreign tax credit. It gives the legal basis for the foreign tax credit. Okay, so it's the document that talks about double taxation and reducing or eliminating the intent to reduce or eliminate double taxation between citizens of Japan and the U.S. Okay, and there's all these different articles, 1 through 15, I believe, and each article describes a situation as to, say, like real estate or capital gains or personal property. There's all these different categories, and but basically this table here, sums it up, and so you can get treaty benefits. The thing is, the typical U.S. person is bound by what's called a savings clause, okay? And a savings clause is kind of a simple way of saying, if you're a U.S. citizen, the treaty doesn't apply to you. The U.S. so U.S. tax laws supersede the tax treaty for most Americans because of the savings clause, okay? Which is unfortunate. Okay.
So the U.S. people have to file U.S. taxes, and people who are not U.S. get to avoid them if the treaty is set.
Yeah. So in most cases, for non-U.S. citizens, tax treaty supersedes local statute, right? So what does that mean? So if Japan says you normally pay 30%, if the tax treaty says you pay 10%, tax treaty rules, okay, which is excellent, okay. The U.S. tax treaty is also very beneficial for Japanese as far as portfolio interest. Okay, so like if you have a Schwab account, a bank account in the U.S., for example, typically that interest won't even be taxable, or be taxable at reduced rates.
Okay, we have a few questions that have built up. Could we do a little kind of quick fire round?
Okay, sure thing.
These are all kind of slightly random questions. So the first one is about inheritance taxes after people leave Japan. So I think this was amended. So when this law came in, people were quite upset, and then they kind of changed the rules slightly to make it less of a burden.
Yeah. Okay. And so this is I'm not licensed in Japan. My wife is, but I've read up quite a bit, and um, yeah, there's all sorts of inheritance that relate, and there's things like exit tax and inheritance that relates to well, you either pay it before you leave, or you can elect to postpone it for 5 years and pay it back when you return, and things like that. And I guess the as far as the follow through, that's I guess you're asking how is it enforced, right? I mean, so
It's quite
you know,
new, so we don't really
yeah,
know, do
yeah,
we?
you don't
Not a lot
really
of
know,
precedent.
but yeah, but um, you know, I think what you could assume is that you know the extent of the law is typically it only the extent of law is only local typically, right? But as you know, I mean, if you're say like a international fugitive or criminal, right? I mean, though they will find a way to go after you using extradition and so forth, right? They will get you the U.S. or whatever through extradition treaties to have them send you back to Japan to face the courts here, right? But you have to be quite a big violator for them to do that. But
Has to be
um,
worth it, right? So,
right? I mean, the whole Carlos Ghosn thing, right? I mean, it's not out, it's not impossible for them to do that, but is it worthwhile and things like that? So you have to weigh those risks. But then also, I think you have to when you're looking at, I think with any country not keeping up with the tax laws in any country, I think you have to be ready to abandon your visa status. And if you're not going to return to Japan, I can't really, I don't want to give you visa advice here, but typically, um, you have to think, well, if I don't follow the rules, then if I return to Japan, I probably wouldn't be granted a visa, right? Because it's going to be on my record. I mean, Japan visa regulations are very strict. If you look at some of the blogs, they say if you miss one pension payment, right, one Nankin payment, and they're not going to renew your permanent residence. I mean, that's pretty harsh. So if you imagine you skip out on inheritance, which is much worse, right? I mean, it's more deliberate probably. It's probably a larger amount of money. So you probably be in even more trouble, right? So
yeah, you'll probably get a knock on the door one day.
yeah.
There'll be some very
So
polite people in suits who want to talk to
yeah,
you.
I think generally what you're looking at too is that even the U.S. is making it hard for people to basically. I think people would typically, if they got into trouble, they would just split town and move to the Cayman Islands or something, right? But you're even seeing in the U.S. now they're putting restrictions on passport renewals. So this is very recent too. In the last 3 years, I think, or so, if you owe taxes of more than U.S. taxes more than 50,000, um, the IRS and the visa administrations, they talk to each other, and you can't even they'll revoke your passport, right? So this has even happened. I think one of Trump's campaign managers or something pretty much was stopped on the runway. He was in some foreign country, the plane was about to take off, and then the authorities came in and said, no, you can't leave because your passport is invalid as of now, right? I mean,
Wow.
that's how. I mean, and he was some sort of international criminal, whatever. They wanted him really bad, right? So going back to what I was saying, if they want you, they will find a loopholes to get you. So just keep that in mind. If you
Okay,
plan to
we
do.
have a super technical question now, which is I don't quite understand. So, how is a Roth IRA conversion treated for a Japanese citizen and non-permanent resident? And how is VA disability treated in Japan? So, two very
Oh,
technical
okay.
questions.
Yeah. Okay. I would say I'm not an expert on VA, but I know for investments, Roth IRAs, they're so-called U.S. tax advantage vehicles, right? So pretty much all the U.S. even traditional IRAs, Roth IRAs, they don't qualify as for tax benefits outside the U.S. Okay, So if say, I had this come up fairly recently as well too. So if you're in Japan long term, for example, Japan doesn't treat, typically the benefit of Roth IRA is of course you pay taxes upfront, or you put into the Roth IRA after tax dollars, so that when you retire, the distributions from the Roth IRA are tax free. Typically, right? If you're in the U.S. citizen living in the U.S., it's tax free. But if you're a U.S. citizen in Japan, they don't recognize Roth, right? So if you're a permanent resident, you pay taxes on your worldwide income. Roth is not tax advantaged or anything. It's nothing. It's just a regular fund as far as Japanese sees it. So you'll pay, typically on distributions, probably that would be regarded as similar to wage income. So you would pay a graduated rate anywhere from probably 15 to 50%, just as you would any other Japanese income. Okay. Not non-permanent residents, that's a little bit different. I think the first 5 years, if you you have to live 5 years or more out of the last 10 years to be considered a permanent resident. But as a non-permanent resident, it's more dependent on whether you remit the money to Japan or if you keep it abroad. Okay, so that's one loophole I guess you can take advantage of. But it's only good for basically for 5 years, right? So what happens after that? Well, guess what? You have to pay taxes if you're going to bring that money in, or even if you leave it abroad in, say, the U.S. or some other country outside Japan, you still technically are liable for taxes on that, because all money remitted to Japan or not is taxable after the 5 years. And so it's not a good long-term strategy, right? I mean,
so basically the systems don't really work very well together.
Yeah, I mean, Roth IRA, typically you think about a Roth IRA, 10, 15 years in advance, right? I'm going to retire someday, and therefore I want to save money. But if this non-resident thing is only good for 5 years, then what do you do after that? You're forced to go back to the U.S., or at that point, do you pay taxes on? It's just, so you're better off not getting into that, and just maybe doing something else, finding some loopholes in the NISA system, non-PFIC, regular.
I guess NISA would be the opposite, right? So NISA would be taxable on the US side. Because NISA is tax exempt in Japan, but if you're a US citizen filing,
that's a good point. But also, Ben, so you have to remember that you might be able to apply if you have accumulated foreign tax credits. You might be able to. You won't be able to apply credits you earn now, but typically, I think in one of my slides, I don't recall which one, I talk about unused foreign tax credits that you can carry them back. Yes, here it is. Okay, you can carry back 1 year or carry forward 10 years. Okay, so this is where you have a little bit of flexibility. So say like you had some taxes that you paid on, typically you own both NISA and non-NISA funds, right? Typically you don't just buy NISA. So let's assume you own both, okay? So both NISA and non-NISA fall into what's called passive category foreign tax credit. They're divided up into baskets depending on the type of income. So dividends, capital gains, and interest would be in the passive income basket. Okay, so you can sort of intermingle these foreign tax credits, and you can carry, and as it says on the slide, you can carry it back 1 year and carry forward 10 years. Okay, so you have a lot of flexibility. So basically, I guess what I said is kind of confusing, but to put it in one sentence, you can use the credits you paid on your non-NISA accounts to offset the taxes on your NISA accounts as it pertains to IRS taxes, okay? So they're
Okay.
fungible.
This might be a good reason to have an accountant. Maybe.
Yeah, they're fungible within the category. Okay, I guess is the, so passive credits, whether it's NISA, non-NISA, capital gains, interest, it's all passive. Okay, so if it's within the basket, you can use it to offset other types of investments.
Okay, I've got some more quick fire questions for you. I think we're kind of done with specific questions from the audience. I've got a few quick ones. So, for example, what kind of person would you say needs a CPA, and what kind of person maybe doesn't need one?
Okay, so CPA, I guess I would say, I don't want to toot my horn or anything, but it's a hard exam. If you talk
Oh,
to
needs to employ a CPA, so not the
yeah,
qualification.
okay. So if you need a CPA as a tax
As a
advisor
client.
or tax preparer, yeah, you don't. Typically, there might be several categories of tax preparers. Like my wife is an EA or enrolled agent, so she took the test that's put out by the IRS. In my case, I'm certified on a state level, as I mentioned, state of Arizona. Okay, so uh, in some instances, my license, because it's state only, it's a little bit inflexible. But I think overall, what you want to look at is the person's experience. Okay, there's a lot of CPAs who don't do taxes. They only do, say, there's a lot of areas of accounting, right? There's auditing, there's corporate accounting, there's there's tax, of course, and there's people who work in the investment banking. People have CPAs as well. They do a lot of stock analysis and things like that, but they don't necessarily know taxes. And even within taxes, there's individual and corporate as well. Okay, so what I'm saying is you want to look at their resume. Basically, you want to ask them intelligent questions. I'm an individual, so what's your experience with individuals? Okay, and I'm an individual. I invest in. I have a lot of Cayman Island investments and this and that. I have companies in Japan and China, and so a typical accountant won't have all that experience. Frankly speaking, I've never done taxes related to Cayman Island and so forth. So my specialty, my competency would probably be limited to Japan and U.S. only. Okay, and if you, I do actually have some customers in other countries like Singapore, Hong Kong, but I do less than probably 5 or less a year of those, right? So as opposed to Japan, U.S. taxes, I do dozens and dozens a year. So of course I have a lot more experience. Okay, so we're sort of heavy on more individual side. So if you have sort of a big KK or that has multiple subsidiaries and you're buying components in Japan and exporting them to the U.S. and you have factories in the U.S. and things like that, that would be difficult for someone like myself, because there's things called transfer pricing involved, where you'd have to price those items that you're transferring out of Japan and putting them into the U.S. Balance sheets and so forth. And so basically, you just need to look at the person's specific background and know how to ask the right questions. And I think the most straightforward way to do that is just to say, here's what I am. I'm a banker or whatever. My salary is $350,000. I have $100,000 in stock options. I have some E-Trade accounts abroad. I also own 50% of a KK here in Japan. Can you help me? If you're upfront from the outset, a lot of people, they don't tell you all this because I think a lot has to do with trust, right? They don't trust you with their personal financial information. So you said, yeah, sure, okay, I can take your case, and then suddenly they're like, oh, by the way, I have a company in the US, and what? You never mentioned that. And so
By the way,
quote, yeah. Oh, so suddenly your quote, my price quote goes from $500 to $2,000, just based on that. And like, what? That's too expensive, and what a ripoff. But come on, you got to be upfront with me from the start, right? So
Right.
let's be fair to each other. Yeah.
So to flip that, so for example, we've had a couple of questions like this. So what would you say would mean that someone needs a CPA rather than just doing the paperwork themselves?
Yeah. So, okay, I guess, if I could rephrase that question, are you able to replace the expertise of a CPA? Okay, I guess that's you as an individual. Say, like, I would say, to each individual, and I've been asked that point blank, and what I say is, well, if you're good, you have to be good at numbers and also good at law, interpreting laws, right? I mean, taxes are basically laws converted into percentages and so forth in various situations. So you have to be able to interpret laws, and of course you have to be good at math, but you don't have to know calculus. It's basically high school math, right? It's mostly multiplication. You have a 30% rate times the principal, 100 grand or whatever, and you figure out the taxes. You have to know how to do fractions. You have to feel comfortable also with exchange rates. A lot of people get confused. Are you able to say, Ben, for example, would you be able to convert $100,000 US to yen in your head? Right? If you're able to say, if you're at that level, then probably, you might be suited for doing tax accounting. Okay. I'm sorry, what was I going to say? Okay, so not only knowledgeable in law, but how many hours do you have to spend? Okay, the laws change very frequently. Okay, since I've been here, there's been, I was here in Japan, and then 9/11 happened. So then you had things like the Patriot Act. Then following that, recently you have with COVID, the CARES Act. And each time there's all these, sometimes major, sometimes it's minor changes to the tax code. I mean, they went from, a situation where a lot of Americans had to pay alternative minimum tax, and then they raised exemption, for example. So typically we won't pay alternative minimum tax now with the latest laws, but they're putting limits on things like, I think last year you could only deduct 50% of meals, business meals, and this year and next year it's back to 100%, right? So how do you keep track of that? I mean, you have to know it, that the law, it was only good for, say, 2018-19 because of COVID or something like that, right? Or some crazy law, or you just don't know. And how much time and energy do you have to keep up with that? And I guess what I could do also now is offer for those who do want to put in that effort. There is, if you go to the IRS website, they do have you can sign up for emails. And that's what I did when I first started my career. Is I went there and I subscribed to. They have automated. They have an automated email service. So if you go to IRS, you just I think you type in the search parameters email and informational emails or something like that, and you can subscribe to anything that you have all these categories. You can press. I think in my case, I pressed international tax topics, and I get bombarded with probably
I'll
five.
stick this in the comments. I think I just found that link. So
yeah, so you can. What I'm saying is you can subscribe to those, and if you have interest, if you want to say, probably a lot of you do your taxes on your own, and you want to continue to do taxes, but you're sort of unsure. You need some information sources. So you go online, but you get conflicting information depending on which website you look at. So you go straight to the source, sign up to these IRS automated emails. It's a wealth of information. Half of it's not relevant. Half of it's trash. It's like interest rates, and you get a lot of. Also, what's really helpful is they talk about the latest crimes and people who lost their license, or they are arrested, sentenced to jail, and you get a feel for, well, what's the threshold? How much? What does it take for people to go to and you get a pretty good idea. And the answer is, if your tax problem is more than six figures, over 100 or 200 grand, you have a high likelihood of facing prison time. That's my conclusion, okay, based on the information I've seen. I'm not a lawyer or anything, but I read these criminal tax crime updates and bulletins and stuff, and that's what the conclusion I've come to. But if you want to do it on your own, yeah, just be careful. The laws change every year. You have to keep up with it. Um, if not, you can hire somebody like us, and in the long run, it might be a better choice. Typically, uh, usually, often in the beginning, especially, I can't say every year you're going to save money, but typically in the beginning, there's something that you don't know of. And Ben, I don't know if there's another slide. I think I'm not sure if I had in there, but it may talk about um, some specific things as far as uh, oh, okay. Okay, I'm sorry, maybe not, but there, I didn't make a slide for it, but okay, let me give you one example what a tax accountant or CPA can do for you. A lot of you don't know that um, filing jointly is much more beneficial. In Japan, you can't file jointly, right? I mean, you basically, each person files their own tax, but you can have the choice of filing jointly if you're married or filing as married, filing separately, okay? And as an American abroad, the IRS allows you to, uh, even if your spouse is not a U.S. citizen, the IRS allows you to treat your spouse as a U.S. citizen for tax purposes. So essentially, you can more or less double your standard deduction. You can be put in a more favorable tax rate schedule and things like that. All you have to do is put out a statement that both you and your spouse signs that says, I would like to be treated as a U.S. tax citizen for tax purposes. Okay, the downside to that is that
be careful because
because
if your spouse has investments in Japan,
if your spouse has a lot of income, has a lot of real estate, owns a company, then that's probably not a good idea because they would have to do all the FATCA information reporting or be subject to, as I mentioned earlier, $10,000 fines per incident for non-reporting. Okay, that can be very daunting. Okay, but option to that is the point I wanted to get to is there is a head of sort of in between status. It's called head of household. Okay, so you could be say like a typical American married to a Japanese non-resident. Okay, if you have dependents, one or more dependents, if you have basically children or grandparents or relatives living with you, you can qualify as head of household. Okay. The only other requirement is that you have to pay at least half of the household expenses for the upkeep of the household. Okay. So, but which typically you do, right? Typically you do. So you can, instead of filing separately and single is the most punitive, the highest, you pay the highest taxes. Okay. So you want to avoid as much possible, either file as married filing jointly, but an alternative to that for spouses who might have high income or a lot of assets is you go the head of household route. Okay, head of household allows you to say, in my case, I'm American, so I would file as a head of household. My wife would not be on the tax return at all. It would just be the information on myself and my children. My children would have to have though a social security number. Okay, so they would have to either have gotten the social security number to pass or have U.S. citizenship to get a social security number. Okay, and head of household, head of household is sort of in between. I think you get $15,000 in standard deduction for singles. Head of household, I think, bumps it up to about 20. Okay, if you're filing married jointly, it's like it goes up to 30. So you get the in between deduction amount, and also the tax rates. If you look at the tax brackets, they're very favorable. So it's good to know. So I guess going back to, do you need a CPA? Well, how many of you out there in the audience knew of that, right? So if you did know of that, then you probably don't need a CPA. Right? But if you
or if your income's really low, I guess, if you're just earning under the foreign earned income.
Yeah. If you're even if you're under the exclusion, you still have to claim the foreign income exclusion, which, if you're not good at math or not so comfortable with law, it still could be fairly daunting, right? Because you still have to fill out the form, and the forms are typically, 3 pages of check boxes and things, and you have to, what type of visa do you have, and when did you arrive, and things like that. And it's just a lot of options that you have. So it could be a source of confusion until you get used to it.
Okay, we have another question, which is, if you don't have copies of your old returns, can you get them from the IRS?
Okay, yes, the IRS, though, I believe you have to pay $2 per copy or $2 per year or something. Okay. However, the IRS has a free transcript service. Okay. So David, that's a good question. So a typical CPA would know how to read that transcript. Okay. And a transcript might be okay for things, related to business as well, or maybe even applying in some cases. Say if you're applying for financial aid or things like that, they might require a tax return. But sometimes for business or things like that, they might be okay with just getting a tax transcript. For you can do that for free. I think you can go back about maybe only 5 years. I think for certain time. I think some transcripts you go back 10 years, but it sort of depends on the level of detail you need. Okay, so
but it is possible to get.
Yeah, it is possible. If in the worst case, I think you can pay about $2 per year, which is not bad. But there is a way. If you go to the irs.gov website and you type in the search parameters transcripts, there's a procedure. You can, online, you can, I think you have to open an account or whatever, go through security clearances, and then you could have access for free, basically for transcripts. They have transcripts for your returns. They have transcripts for your accounts, so you could see how much, say, was withheld, the history of payments you made, refunds the IRS issued, things like that. They have some pretty comprehensive options or basic ones that just show your tax return. There's several options you have.
Okay. We've got two quick questions from a crypto enthusiast, it seems. So can you recommend any websites or resources for US citizens to read about taxes and retirement laws in Japan?
Okay, I think I have to defer to Ben on this, because as far, I mean, taxes other than the ones I've mentioned, I think you can get a lot of contradictory information, so you want to go to the source. But when you do go to the source, often it's more confusing. Okay, so, but as I mentioned, the law changes pretty much, every 2 years or even sooner. So, let's just say, for example, if you made some retirement investments based on current laws, what if you find out 5 years from now the law has changed? And, so you have to have a little bit of predictive ability as well, right? I mean, just because that's the law today, a good example is I think a lot of you have heard of the backdoor IRA, right? So it's a kind of way to increase, how much you can put into your IRA by going through this backdoor route. Okay, and so it's been sort of under the radar, but because I think people have been publicizing on Reddit and on the internet, I think it's caught the eye of the U.S. Congress. So I think there's a lot of movement to stop the backdoor IRA, right? So what does it do for people who've already, invested in it, right? I mean, you've done this for 20 years, and this has been your retirement strategy, and suddenly it's gone. I mean, so what are you going to do now? And so, so that's where that's why I say, always go to the source. If you do look at second, third party websites, just sort of be skeptical that those laws won't change. A lot of times they might be selling you products, they want a commission usually to sell you those products that promise tax deductions, but they probably already know, they're going to change the law. This is not going to be valid in 5 years. So they're just trying to sell you as much product before the law changes or something, right? So just be careful. And I would defer to you, Ben. I think you would know probably better as far as investments. There's a lot of sites out there. I know of a few. My favorite one was the Bogleheads
That's wonderful.
website.
Yeah, the
Yeah,
Bogleheads forum.
Bogleheads was sort of the go-to website. I think John Bogle, I think he passed away fairly recently, but he was sort of the guru as far as mutual fund index investments and getting mutual funds at low cost fees. Less than typically less than 0.5%, pretty much low cost, tax efficient investing at low cost, basically. So I think it's bogleheads.org.
Yeah.
Okay, but then again, most of the investors are U.S. based. I found a few threads on Japan, but it's mostly if you live and work in the U.S. Okay, unfortunately, there's very few. I mean, I think there's only probably 20,000 American residents with permanent residence, right? I mean, we're just a drop in the bucket here,
something like that
in Japan. So yeah, so it's not a lot of information. You just have to kind of scrounge around and do your own research.
In Japan, I like Reddit's Japan Finance sub is pretty good.
Oh.
And then the Retire Japan forum is a good place to ask questions.
Oh, excellent! And of course, your forum too, Ben. Right?
Yeah.
I've read through your and I think the fun thing about yours is you have a lot of sort of anecdotal stories. I think you share a lot of personal stories about your health and going through. I think you went through a very major kind of hip operation, right?
Yeah. A couple of years ago. That was fun.
And yeah, you're sort of and things like that. I think it just makes your website, your whole presentation is very interesting, and on a personal level, it's not uppity up and sort of high finance. It's very down to earth and relatable. So,
oh yeah. I don't know anything, so it's
I think all the listeners appreciate that, myself included. I get kind of intimidated by high finance people myself, so I try to explain it in simple terms, and I think you've done a great job, Ben. And
Thank you very much. I think you've done a nice job today as well, explaining things to our listeners. So
Thank
are you currently accepting new clients?
Yeah, so currently, I mean, we're sort of past the tax season for 2022, so we've gone through and done the bulk of tax returns, but of course we're still accepting. U.S. taxes are really kind of a year-long thing, because there's always people, say like if you're involved in a U.S. partnership or something, you don't get the so-called K1s until maybe June, maybe this month. Most of the tax, for most people, they get their tax forms by February. But if you're, say, sort of involved in a partnership or some kind of LLC, your tax forms don't come until June. So those are the types of customers that we're dealing with now. LLC people doing real estate and things like that. So typically between June and October is sort of the next busy period. And typically after October, it's pretty, we do a lot of, that's when I do a lot of my continuing ed, take my classes to renew my CPA. Also, I do a lot of, meetings at the time. I don't have a lot of time to meet with clients during the busy period. So if people need to meet, they want to have sort of, half an hour, maybe an hour, or sometimes even more to talk with me. Typically, I'll do that in the fourth quarter of the year. Typically, first, second quarter, very busy. Third quarter, a little bit less busy, but still I got clients trickling in. And of course, if you are one of those people, I'll be happy to take a look at your situation as well.
How can people contact you? Can we share a link in the description later?
Yeah, I think the best thing where Ben, you found me through LinkedIn.
Yep.
And so I'll
just post your LinkedIn details here, and then people can get in touch if they're interested.
You can contact me through the messaging there, or I think if you look at the about section of my company, I think there's a email address there, sort of hidden. But I still get tons of spam just because I put that there. But some people are able to email me, but most people they'll send me a LinkedIn message, and then from there I'll give them my email, and then we'll follow up. Yeah. Also, just a caveat: LinkedIn, third-party apps are not the IRS and other typical CPAs. They don't recommend you sharing your personal financial information through third-party apps, like even Yahoo Mail, LinkedIn. If you're gonna share your personal finances, you're probably better off doing on email, not or another non-third-party app, just to be safe.
Right. The initial contact, though, they can get in touch with.
Yeah, initial contact, of course, we can share our background information, and then we'll probably switch to email quickly after that for, just to ensure security and confidentiality of information.
Wonderful. So, yeah, so if you need help with your US taxes, then just get in touch with Dean, and hopefully he can help you out.
Okay, appreciate it. Well, we've gone more than an hour and a half, Ben.
It's impressive.
Sorry to, hope nobody.
Fantastic. Thank you so much, Dean, for taking the time to talk to us today.
I appreciate your invitation and being
and
patient
answer all
with
those
me.
questions.
And sure thing. And I'll be available to follow up. If there's anything else, of course. Or if things weren't unclear. I know I sort of rambled on through a lot of these answers with some technical terms. So if things are unclear, please feel free to contact me, probably through LinkedIn, and I can, perhaps clarify in more layman's terms for you. And great.
Wonderful. Thank you very much, Dean.
Okay.
And
appreciate it so much. And
see you
to
around
your wonderful
LinkedIn.
clients.
I'm sure in the comment section.
I thank your clients for their, very intelligent group you have here. Very, I can tell, proactive and, very intelligent and on top of things. And so I wish them luck in their tax endeavors, and wish you luck with your Retire Japan business as well, Ben.
Brilliant. Thanks very much, Dean.
Okay. Right. Thanks so much. Take care now. Bye now.
Right. Thank you so much to Dean for joining us today and going through all those questions. Right. Daniel is not here. So we've decided to postpone the regular Retire Japan TV content. So that would be the news section, our deep dive, the forum kind of dive, everything. We're just going to do it next month. Sorry about that. The next Retire Japan TV is going to be on July 24th. We have a mystery guest because we don't have a guest yet. But we will have a guest on July 24th, same time, 8 p.m. on Monday. And I hope you'll be able to join us there live if you want to join the discussion. And you can, of course, access the videos on YouTube, LinkedIn, and Facebook after the event. So thank you very much. Good night. Have a good month. And we'll see you again in July.